Alright, so in this video we're going to be talking about be in regular occurrence around this TEDT trading system. This is a Great British Pound US Dollar chart on daily candles. It's the 15th of October just now. You can see it's on a downtrend, but what I'm going to do is going to go back in time a little bit and just walk you through this uptrend that we had and label all the buying and selling opportunities that came around. I'm going to first of all start on this the range market that the price put up at this point. You can clearly see it's a range market by the Bollinger Bands nice and flat, the bottom bands as well, so this gave up a great buying opportunity right here. If you got in, you could have got in early. You could have sold here by using the range trader tactics. So you can see the Bollinger Bands just started to level out here. You can see they're pretty flat here. They're laying very horizontal. Same with the moving average. It's just giving you lots of signals that it's a range market, okay, which means there's no volatility in the market. The price isn't going anywhere until something actually happens. So when there's nothing happening in the market, the price just moves sideways. The Bollinger Bands come to a close and make a Bollinger Band squeeze. They'll start to increase as the volatility expands. But this is the least amount of distance the Bollinger Bands can actually go. When they're at the lowest levels of volatility, that's when you switch to your range trading tactics. So you would have been quite lucky to sell in here. It is an evening star if you blend these two candles together. This candle closed more than 50% of this one. That was a sell opportunity. If you go back, strengthen the trade, you could probably find some support and resistance there somewhere, but we're not going to look at that right now. But anyway, when the price came down, this is a surefire nice buy signal right here. Same scenario, flat Bollinger Bands down the bottom. You can probably find some support and resistance. As you can see, this candle right here, that gave off the bottom of the range. This candle here was the top of the range. Excuse me. Okay, and this engulfing bullish candle was a definite buy. So at this point you're risking a little over 200 pips. And the profit target, as we always talk about on the range trading, is the opposite side of the Bollinger Band. So we're risking 200 pips and we're looking at another 600 on top. So that's a very nice profit to loss win ratio. Okay, so that's just a scenario of a range trading. So if you buy at the bottom, sell at the top, make your profit targets the opposite side of the Bollinger Bands. Make sure your risk to reward is favourable, which means for every one you risk, you must take equal to one or more than one in profit. Obviously, the more the better for your ratios. Okay, so we now know that after this range breakout, we are now in an uptrend. So we're going to be, the price is always above the moving average now. You know you've broken out the range. You could have, there might not have been a range there. You might have changed the trend, which we'll talk about at the end of this one. But basically, as of this candle right here, we have switched the tactic from range trading to long trading. So the deal is we're looking for buying opportunities. So the market conditions state that we have to be above the moving averages, which we are. I'll just get rid of this. and what we're waiting for is a pullback in the price, which we can see is happening here. And what we want is either a candlestick or a trendline break off of some form of support or resistance line. Now we can draw in our Fibonacci's like that. You can see there was price reactions on the Fibonacci's on the 38.2 level. Now this would make for a nice buying area if it wasn't for this large candle here. This candle was a little bit too large. We'd be looking at risking 300 pips on the risk side and gaining only 85 on a profit. This is basing before we place our trades. We always assess our initial profit target for basing a trade on is the Bollinger Band. So let's just say if you opened up at the bottom of this candle, you would always just go straight up, check the Bollinger Band, and right there I would say 284 pips. So that's how we assess the profit factor in a trade before we actually place a trade. Now, because this price actually shot up, excuse me, and it became too close to the Bollinger Band itself, there would be no trade taking their place because the profit to risk to reward ratio is completely out of sync, so there would be no trade there. Another situation came up here where we got a downturn in price. The Fibonacci still stands from the last one because that's the bottom of the move right here, and that's the top of the move. You can see we've got a little double top on this little price here. Price came down, retested the support on the 38% and broke through the trend line. So that's a nice entry right there. You got to remember that at this point of the trend line being broken, we cannot see any of the future. Okay, if you were looking at it, this is what you would see. Just this one candle sticking out. Okay, there is no telling whether it be going up or going down. So this nice uptrend, we didn't know it was there. So what do we do on this candle? Have a look at what we're risking. 150, leave room to move, round it to 200 pips. Okay, it's just a guesstimate, you know, you want to leave some room, as you can see here. Leaving room is always a good thing, because if you place a hard stop directly or 10 pips below that low, you would get stopped out just before. So I always state in my systems that we should place 50 to 100 pips below this point or above your other candles. So 50 to 100 pips beyond. Depends how much we're initially risking. With this case, 200 pips. Yes, I would have just rounded up to 200 pips, and I would have based my lot size accordingly to the money management principles at the time. So the price went up over a couple of days, came back down, and it's retesting the Fibonacci support levels that are around here. There's some price reactions, and if you place a wide enough stop, you would have been in profit. Now the profit target on this, we're looking for the Bollinger Bands, which were straight up, so it was 341 pips profit potential we were looking at compared to 200 pips to risk, so that's a nice one. And the price took quite a while to go up. Now please remember that although we place our profit targets in here for our analysis before placing a trade, it is not a hard take profit level. You leave that open to your suggestion and your analysis, such as there's a few ways to get out of a trade. What I would do is put another trend line up. when the price fails to carry on and breaks your trend line. That's a nice way to get out of the trade. So as soon as the candle opens up through the trend line, that'll be an exit on the trade. Now in this case we'd have exited on a 275 pip profit, which is okay. Price went up a little bit more, came back down, went up a little bit more, but coming down in price is perfectly okay. I'll show you why. So let the market fluctuate, don't always stay in for the long term. We got another downtrend here. We're talking 1, 2, 3, 4, 5 candles. Nice little downtrend, down for a week. This candle looks pretty big though. We might be lucky to get a 1-to-1 reward here. So there's another one. I would just round that to 200 pips, and profit potential was at 181. Not quite good enough. Wouldn't be happy at that. Okay, so sometimes you got to let some trades go for your own best interests, but that's why we trade 6 different currencies. Okay, so there's little chances that come about all the time. So let's talk about this one. You might have got in there. It's a very steep trend. We want to try to find something slow, gradual, over 5 to 10 days, like here. If you're only talking a 3-day retracement, it's pretty short, it's pretty sharp, not exactly favourable, but we'll have a little look anyway. So you'd be looking at risking 85, possibly 100 pips. Price went up, came back down, and we would have hit a target of 221. So if your risk tolerance there was pretty high, you could have getting yourself a couple hundred pips over 100 pip risk, which is good. Not necessarily in my book of textbook trades, but sometimes they do work. Another conservative one, just drawing in that pattern there. So got a trade there, trend line break, 185 pips, probably round up to 200s, profit potential 150 right there. Not great at all. Okay, the reason we do this is if the price is too far up, you know the market's fairly oversold, and what we're looking for is overbought. What we're actually looking for is oversold conditions. We need a good discount on the price before we buy again. That's why we wait for the price to come down a little bit more. So you need to be, your profit potential needs to be favourable. Okay, so basically all we're doing is looking for these downturns in an up market. This is the best place to buy your stocks, your currencies, whatever. Okay, buying low in an uptrend. So here's another one, candle break off this trend line right there. You probably could have even entered on these 2 candles. I bet you if we throw up this Fibonacci's from that bottom to this high, because that's the move, look at that, 2 nice almost spinning tops, spinning bottoms right off there, spikes, whatever you want to call them, off the 50% Fibonacci. I'll get rid of this trend line a wee minute just so you can see it. So if you were trading that would be a nice little opportunity on its own, and this is great because the risk to reward, you're talking 75, 85 pips and a profit potential target of 311. Now the price did go up a bit more than that, marginally, but it's good. It's good. If you fail to get in on those particular candles, your next entry would have been a break of the trend line. Maybe favourable, maybe not, but we'll have a look. So candle open through the trend line, risking 160, 175 pips. Stand again 237. So that would be a good trade on its own as well, based on the trendline break. I would have taken that, and as you can see, price moved in our favour. Okay, so this occurrence happens all the time. It's just looking out for it's a great thing. So downturn, yes, few days, not great. Price is still very close to the Bollinger Band, so I wouldn't even consider any of this. A few days after, got another downtrend. This candle opened, this would have been just after the weekend. The market opened up quite a few pips below the close price and came up. It'd be too risky to make a trade decision based on that candle, because there was something going on at the weekend there. So 3 days after, we got a trend line break, looking to risk 140 pips thereabouts, and 242 pip profit potential. So that would be a nice trade based on a trend line break. Find out support and resistance levels, so draw your Fibonacci's in. Yes, bounce off the 61.8. I'm sure you could find some form of support and resistance there. See off the top of that candle there, boom, right there. And now you've got a confluence of support and resistance. In this case, it's a support because the price is coming down and it's finding support. So nice two little things coming together there with a trend line break. That would have been a nice trade. Okay, so market didn't retrace down until here. Got another downturn. Before we go there, we're going to talk about this one with its profit targets actually. So your profit targets would be Bollinger Band. Okay, trend line break. So the price went up, came back down. We've got 2 points to draw a trend line from right now. Okay, so price goes up, and we could have gotten a exit signal right there. So this candle open right here. So 245 pips that would have gone based on just entry and exits from trend lines. Okay, these are the tactics that you use in this trading system. Base your entry on a trend line break, and one of the exit strategies is to utilize the trend line and exit on a trend line break. Now, a few other ways of exiting: exit on the touch of a Bollinger Band, exit on a price you're happy with, like say for instance if the price goes to a 3-to-1, 4-to-1 risk to reward ratio, and any losses that you've had, if you've had 3-4 bad trades before and this one trade wipes out 4 bad losses, sure, close the trade, take it out, be happy, forget about all those losses. Take it on a dollar figure that you're happy with. If you find out you just made $1,000, $2,000, $100 on a trade, and if you're happy with it, hey, take it. As long as it's meeting your the average win to loss trades, as long as whatever you're exiting on your winning trades is higher than your average losing trades. Okay, so that was an exit on that. So we exited the trade, and we're looking to go long again. So here's another one. A little puny candle here. I wouldn't really base a trade on that too much. Let's have a wee look anyway. Okay, it did bounce directly off the 50% Fibonacci. Fair enough. Bit of support. Where's the candle? What's the candle? Can't find anything about here right now. Maybe back in time a bit more. It's a good thing with these horizontal support and resistance lines, they can go way back in history. Look at that. This is back to April 2011. That support and resistance level that I just drew in right there is flagging up as yes, this is a good level. So zoom back into that trade. So on second thoughts, if I was looking at this trade and I had nothing else going on, I was looking for a bit of excitement, I probably would have traded this candle, no matter it, although it does look a little bit feeble just now, based on the other conditions there, you might just take a shot at it. So let's just have a look at the money management point of it. So looking to risk 80 to 100 pips, profit potential 163, which sounds all good, so probably would have initiated a trade. In this case, broke through a trend line, you were probably in the trade, probably got up about 20-30 pips, up to about 70-80 pips, and then the price starts coming back down. At this point it would have taken out our stop loss just if we set it about 85 pips, which would have been about here, before continuing on in the relevant direction. Now these things do happen. I don't suggest that anybody should trade without a stop loss. I know that's how a lot of people feel how they should be trading, because when these things happen, when the price just marginally comes down and then continues, but trust me guys, you've got to trade with a stop loss, right? These things will happen, but you can always recoup your losses from one little trade. If you traded with a stop loss and then this thing happened, you're not coming back from that. Okay, you'll be refunding your account. So always trade with a stop loss, please. Take your losses, take it well, learn something from it. So you could have placed a stop loss a little bit more, give it a bit of room, but whatever. Anyway, another strategy I talk about on the book is once the price moves halfway, so entry candle there, so 160 pips. So if I got to 80 pips, 80, so if the price got to there, should have moved the price to break even. That's one strategy that I've got in my ebook, and what that would have done is protect the position from 1, 2, 3% loss, whatever your money management is. So there's a little rule of thumb to think about. Once the price gets up halfway, and this would have been 1, 2, 3 days, 3 days afterwards you place your trade, move the stop to break even, and that way all the risk is taken out of the trade. You can sleep at night because you know you're not going to take any losses. All it's going to do is break even at zero or hit your take profit. Makes you sleep a lot easier at night, trust me. Okay, but in this case it took the stop loss out and we took a little loss. Another one, trend line. Okay, it's very steep. We can see this candle right here, same situation as we talked about before. Price broke through and it's too close to the Bollinger Bands for the amount of risk that we're going to place. Now, would you trade this? No. We would have missed out on this one. Why? This candle, it was a bit too strong and trying to test this support level. We didn't really get a rush up through until really later on, but placing a trade there would really concern me. It did work out after all, but if you're not sure about things, just stay out of the market. There's plenty of other opportunities on other currencies. So then, market goes up, and before we know it, as we can see in the future, something changes and the price just crashes. Now, who knows what's been causing that? It's just the way things are working right now. So, what do we do when the trend changes? Okay. How do we know when to switch strategies? Obviously, when the price is below the moving averages, we're now a short market. How do you know when to stay out and be cautious? Well, get rid of these a minute. When you're in an uptrend, trend lines are your best friend. Use these, use channels, use them to draw patterns. Okay, you can see right there. Use it for drawing channels like so. Okay, you can see the price broke through the trend line, clearly well above the moving average. So as soon as this happens, it's not a signal to buy or sell, it's just a signal to be cautious about what's going on. Okay, market's been moving up for quite some time, with no major percentage of a pullback. It might have been just pulling back 1 or 2%, you know, but it's only up until you get this trend line break and the market just keeps on tanking down. Okay, so you might have been looking to buy all along this level, so at this point we were drawing our trend lines in, just waiting for that pullback, which never happened. They broke here, kept coming down, and that's the time to say, right, okay, time to be a little bit cautious, maybe sit this one out for a little bit, just see what happens. Okay, so what did happen, we can see here Bollinger Bands, keeping an eye out, moving average started to level out, and bottom Bollinger Band leveled out as well. So we're only assuming right now, as of these candles here, we're in a Bollinger Band squeeze. I'm anticipating a range market. This point it never happened, but what I would have done at the time was this engulfing bullish candle right here, the green one, which doesn't dwarf, but it fills the last candle there, so it shows a bullish emphasis on the price. So I would have definitely placed a trade there. Same reason as the range market on the beginning of the video. We would have placed a trade based on these same trading results. Just because I can see what actually happens in the future doesn't mean that I'm not going to show you what actually happens. Yeah, it was a losing trade. A lot of people wouldn't even point that one out to you, but you know, losses happen all the time in the market. It's all about protecting your positions and getting the highly probable moves in your favour. So at this point we would have been risking about 70 pips, 75 pips, giving it a little bit of room to move. So with the anticipation of it moving up to the top there, which was around 600 pips. So that's definitely a trade you should think about if you're going to be risking 75 pips to gain 600. That's almost a 10 to 1. So you'd be absolutely mad not to try and trade that. So anyway, we lost out in this position. The market's making a lower low now, so we know for definite it's in a short trend. Okay. Another warning sign about change of trends. This here on the A, B, C, D formation. If the price breaks below the C, then something has definitely changed in the market. The A, B, C, D formations have changed. It is no longer in an uptrend. If the price broke through the D, then obviously we are still in an uptrend. If it breaks below the C, then we're in a downtrend. It's the same vice versa on a flip. I'm sure another video somewhere will be talking a little more in depth about the ABCDs of the markets. But that's the situation. So you got a warning sign here, you got a warning sign here. Fair enough, you went to range trading tactics, but you can see the market's actually giving out signals that something's up, something has changed. So you know you're short, going to get rid of this clear things up a bit for you. Short market, short market, short market. Let's zoom in a little bit. Now, would you find the opportunities in here? Well, the market's very strong. It's still extremely close to the Bollinger Bands, so there'll be no opportunities in here, not with this trading system anyway. If you decided, okay, there was one here, it was off the trend line, but you're looking at a 200 pip stop and a profit potential of 108. Now, the price could have bounced here, could bounce here, could bounce here, could bounce here, who knows. But this is the way we play our analysis on the trades, okay? If you're risking too much more than the profit potential, we do not place a trade, no matter if it did work out or not. Okay, certain situations come about, as we've seen in this uptrend, which can be favourable. This is a slowly moving trading system. You might be waiting a few days for certain trades to come out. It might be days without any action, but that's what goes about. There could be other days where you could be in 4 currencies at the same time, or one of your trades be going for 20, 30, 40 days long. You know, if you switch to a weekly candle and find out the market's going up and up and up, you could be in it for weeks. You could be in a position. So anyway, let's have another little look. Here's a beautiful Bollinger Band squeeze right here. I'll zoom in a little bit for you. That's just a prime example. Okay, flat moving average, flat bottom Bollinger Band, flat top Bollinger Band. This can't get any closer together. This is the furthest to the closest together it can get. So it's flat. Okay, and then look what happens after the squeeze. Now, it didn't really create the best opportunities for buying at the bottom and selling at the top. Gave a nice candle here to buy. Price went sideways for days and days and days. Now, if you bought into that one, you'd be looking at 64 to 80 pips. Price went sideways for 45 trading days before it started to gain a little bit of momentum. But you can see what happened when it breaks out the range. That's it. You were laughing after that. That's why when we buy at the top, sell at the bottom, it's important to wait for some sort of a confirmation that the price is going to reverse. If you place a hard take profit level here, like if you did it in this case, and if you had no inclination of a reversal, you would have missed out on all of this. So in range trading, we don't actually place hard take profits. It's more of a guideline to take it out. Keep your eyes on it. If you get a trend line break or a candlestick formation off the Bollinger Bands, then definitely that's a good sell or buy indication. But when the price powers through like this, you don't want to miss out on these opportunities. So, okay. As we can see, it was a nice uptrend. Man, it went for pretty steep. Okay, there was no real opportunities for us to buy in here. Price was beyond the Bollinger Bands, which is it's actually beyond our take profit level. So we need the markets to be in oversold conditions. I just actually done a counter trend trade on this because I seen the market was so overbought that I actually placed a sell on this. Just closed it What was that, a couple hundred pips I got, so 300 pips. Even though it's a long market, it's not something I do all the time, but in exceptional circumstances then I will. Okay, so we are looking for a downtrend. So in this case, price came down, tested the 50. I'm sure it's going to come back down even more, 61.8, and more than likely, very likely, because it's such a highly volatile market right now, it's probably going to come down, touch 78.6. This is not a buy or sell signal if you see this in the future, by the way, but merely it's going to come down and test the support of this range, which just happens to be in this general area, 78.6, the moving average, and a support of the top of the range. So I think that's very likely, but it's going to take a good few days to come down. I know it's been coming down hard over the last few days, but it should start to slow down and start giving some sort of signs of reversal before it starts going again. It might not, it might keep going down. We can only put probability in our favour, I guess. So Euro, Japanese yen, I just got stopped out on a trade here the other day, yesterday in fact, because I was basing on a Bollinger Band squeeze coming in here. Just had a little reaction in there. Yeah, place a trade just on a Bollinger Band, just looking for a bounce up. Nothing happened, stopped me out. Probably was a bad trade because there was no relevant candlestick formation there, so teach me a lesson. See, everybody makes mistakes, just getting excited, placed a buy signal, and yeah, it came down, stop out. So let's have a little look back on this. So these markets, okay, there's a Bollinger Band squeeze right there. This instance, price came up, questionable candle formations there. Some people, there are tolerance levels, some people would have sold, made a few pips out of it, but there you go. Now as we can see, so if the price breaks out of this, then we know we're in an uptrend. Okay, so we're long, probably could have bought there. Okay, 222 pips, man, that's volatile. And yeah, 331 pips profit. So that trade on its own would have been good. Let's just see, that was getting in on a candle. If you got in on a trend line break, let's see what that would have came out as. As you can see, nearly 400 pips and then 167 pips profit. So you would have only really got on this engulfing bullish candle here after a few little spikes of, doji candles with no momentum. Price went up and up and up for a good few days, looking for a sharp sell-off. In this case, this one happened right here. You can just tell that the distance for your stop loss here is going to be incredible. 640 pips to gain 640 pips, 650. Nah, doesn't suit my appetite at all. Delete that, wait a few more days, got another downtrend right here, maybe a little bit more favourable, but in this case you got this large rush up candle, which I'm not even going to bother to tell you what the support, what the risk to reward is. Now, as you can see, that excuse me, this currency acts a little bit more differently to the Great British Pound US dollar. This is the Euro Japanese yen. That's why it's important to trade a limited amount of currencies. I trade with 6 so I can get more action. If you can trade 4, that's brilliant. But every different currency has its unique characteristics. Although they all look the same, they all have bar charts, they all have the same moving averages, Bollinger Bands. The price goes up, the price goes down, but there's a lot of language in there that's slightly different to its next chart for its different currencies, and it's up to yourself to find out the characteristics of the currencies, how volatile they are, so they all react differently, so it's important to find out. That's a large stop, 443 pips there, profit potential of 555, which sounds all good, but it is a very large stop. You could wait for a retracement to get a smaller stop loss, but it never really happened. It's kind of hard getting in Euro Japanese yen because it is so volatile, large moves. But when you do find these opportunities, when you do get in, your trade can go a nice long way. But it's trying to get in on small opportunities, small stop losses, and just trying to gain from that. But Euro yen is definitely a good one to keep having on your charts. So there's a 200 pip risker. 140 pips profit. That would have been good. The only way you could get in is if that actually displayed a different candle, then it would be a good place to get in. Okay, don't forget to draw your Fibonacci's and support levels in before you're looking for your trade. So I'm just skimming through here. So there's a nice candle formation of the 61.8% Fibonacci right there. Just go back, see if there's other relative support and resistance levels. Not so sure. Have a look at the weekly chart. So where were we on that level? Up, down. So yeah, price reaction was there. Nothing for weeks, so yeah, I'm not going to worry about that too much. So yeah, price reacted. You can get on that candle. It's a piercing pattern, 130 pips. Piercing pattern, which means spike. It came down a little bit lower than this one, but the candle actually closed more than 50% of the previous candle. So piercing pattern there is the opposite of a dark cloud cover, which happens only at the top. Piercing patterns only happen at the bottom. So 130 pips at risk, and as you can see, the profit potential was potential's up there. 800 pips is probably a little bit exaggerated, but you can change the other tactics to you can get out in candle formations. You could have exited here. Just need to start drawing your technical analysis tools. So there was a confirmation of, so you would have entered there. There was a confirmation of your trade here, which was a good many pips away. You got in nice and early. That's 230 pips away that you've increased by getting in early due to a candlestick. That's why candlesticks are so important. So at the point when it made this high, you could draw in trend lines here, start based on a trend line break, exit. So when the price broke here, you could exit on that. That would have done me perfectly. Another one is drawing your Fibonacci's from the top of the move to the bottom, waiting for your Fibonacci retracements before it starts going back down or up. So you got a reaction off of here. If you held on, price came all the way to the 78.6, gave a engulfing bearish candle. went down, came back up, almost tested the 78.6 level again, threw up this nice little spike, another exit signal, and engulfing bearish once again, another exit signal. So that's why exiting trades are always questionable, and they will fit different needs of other people. So you might expect a lot more pips. You might be looking to get in and out quickly, taking the risk out of the trade at a profit. It's all down to you. You need to do your own analysis. You need to go through all my videos, pick up all the little tips and tricks, exit strategies. Okay, so we know we're still in an uptrend at this point in time. We can see here, we don't need the Bollinger Bands right now to tell us that we're in a range market. Just look at the price, it's going sideways. It's been going sideways for days. We're still caught up in this range of this big move, the big move up, the big move down. If this is the A, this is the B, this is the C, right? We're still caught in this range of the B and the C. The price can continue on in this range forever if it wants to, but it's got to be trending if it makes a new high or a new low. The price can move along here as much as it likes, so you need to watch out for these conditions. This is what I always talk about, being an agile trader. Although all the conditions say that you are in a long market, the price is above the moving average. Whatever you risk here, the profit potential always actually looks pretty cool. So you'd be tempted to take the longs on these trades. So you'd be going long here, just say. You'd be going long here, just say. But for days and days and days and days, you're getting caught up in this sideways moving up and down market. Boring, frustrating. So if you see this with no real clear opportunities, just close it, stay out of it, don't let it bother you until next day you come open up the charts at the end of the day. You find the price up here or down here and reacting off a squeeze, then you react to it. But if it's chopping about in the middle, stay out. So as you can see, price came down, give a nice couple of little spikes off the Bollinger Bands here. Yes, I would have placed a trade right there, double spike, no doubt. There's some form of support and resistance there. I'm not going to do it just now, but you would have got in nice entry signal there. Okay, so 92, 95, price went up to 120 before it crashed back down. Probably would have placed a trade in there again because there's that engulfing bullish candle off the moving average, off of the Bollinger Bands. Got a nice little spike after it, all looks good. Price goes up but fails. Okay, price comes back down through the moving average. Now you're chopping about all over the place. We're not quite in a range because the Bollinger Bands are pointing downwards, so there's some emphasis that the market is moving down. Bollinger Bands need to be flat. Although the moving average is flat, you need them both to be flat to confirm a range market. Okay, and in this instance got a large dramatic spike, and the price moved up after that. That's a beautiful sell signal. Getting stuck in a range. Whether you would take that was a big pips we're talking there. Well, not too bad, 172. But you can see now, flat Bollinger Bands, flat Bollinger Bands, flat moving average. See what happens to the price over the next few days. Might be able to get in, yeah. Okay, so hopefully we've cleared up a few things on how you should enter trades. Get a better picture on. So when you go to the book, compare the notes to what we've been talking about in the video. And basically what we're looking for is, if you're in an uptrend, we're looking for a short counter trend, and we base our entries on candlestick formations. If you can't get in on a candlestick formation, get in on a trend line break. Okay, but it's got to be these certain conditions. In an up market, you've got to be above the moving average. The price has got to be far enough distance away from the Bollinger Bands so that your risk to reward ratio is favourable. Okay. Same as it, if you're in a short market, the price has got to be below, and the price has got to be a nice relative distance from the Bollinger Bands to make the profit potential rewarding more than your risk. So when you're in a downtrend, let's find a downtrend. What you're waiting for is a move up to a support or resistance level, like that. Okay, price move up to a resistance level. Resistance for when the price is below and it comes and tests it. Support if the price is above it and tests it. So that's support, that's resistance. In this case, it never gave off any candlestick formations. Could have utilised a trendline break. Okay, would have got in there. That's what you're looking for in a downtrend, below the moving average. Unfortunately, this one wasn't a far enough distance away from the Bollinger Bands to make it a worthwhile trade. As you can see here, it's more than halfway. So, unfortunately, we would have missed out on that one. But move up, counter trend line break or candlestick formation with the price move down. Okay, same here. Price move up, short trend below the moving average, candlestick formation. You would have entered just on that alone, as long as you were at a support or resistance level. You can see here, well, nearly. There's probably a Fibonacci in there somewhere. As you can see right there, 61.8%, thank you. Would have traded that, would have picked up a nice amount of pips there. So risking 230, potential for 1,000. Yep, price came down, just touched the 1,003 mark, so would have been happy at that. Exit strategy from the bottom to the top, top to the bottom, sorry. You could have exited there. If you had a pair of brass ones, you could have held on, waited till it touched the bottom Bollinger Band, but it's not always the case. It's not how I would work it. I would have taken it well before that. Be happy at a profit. In fact, another thing you can do is, once it actually breaks to a new low or a new high in the uptrend, start considering taking your profit shortly after that one, because the extension is limited. That's where you can use Fibonacci extensions as well. Let's have a wee look. I don't think this is drawn. No, 127 is not on here. Just add. Just add in 127% Fibonacci extension there. So as you can see, the price came down and just extended beyond it. So that was a low, price came down, made a 1.27% extension, and then before I decided to skyrocket back the other way. So there's lots of little tips and tricks and exit strategies and take profit levels. Okay, so get back to your book, refresh yourself with the rules of trading, download the template for the trading. This is just a simplified version of it. What I like to do is change my properties, change my foreground. I have the red for seller's market, so when the price is below moving averages, I like to have red outlines. When I'm in a buyer's market, I like to make it a green one, just to clearly illustrate if I can't see the moving averages at the point of time. I can just clearly see the chart is green. I know I'm looking for buys. Okay, just makes it look a bit better. But that one's a red just now, so okay. So back to the book. Refresh yourself. Set your charts up. Get the Bollinger Bands on. Get the moving average on. Start having a look at previous trades like we've been doing. Go back in the chart history. Find these little trading opportunities that we've been just going through. It's always kind of hard looking at it in hindsight because you know you can just see on the chart the price is going up or going down, so you tend to be a little bit favourable and skip over a few trades that you know that are not going to work out. It's not always the best way to do it. Just be truly honest with yourself. Just go back 1 year, don't look at the charts, and move it and work candle by candle, saying, would I have made that trade? Would I have placed this trade? Would I have traded there? And then candle after candle, would I have taken profit? Would I have taken profit? Would I have taken profit? Okay, there's a engulfing bearish. I probably would have taken profit after that. Don't kid yourself. Just go through, do your own back testing, and give yourself a little bit of a true analysis. Find out if this system is for you. It is a good system. It puts very highly probable situations in your favour. You're buying at discounted price when you know that you're actually in an uptrend or a downtrend. You know you're always getting a better price in the currencies, with the intentions of the currencies actually continuing on in that relevant direction. So it is a very probable trading system. It isn't very action packed though, that's the only problem. You need to be pretty disciplined not to chase trades. Only place trades that are based on the system. I know what it feels like when you have periods of time of inactivity in trading. You feel like you always need to be in the market, but it's not always the best way to trade. You'll find the more you want to be in the market, the more chances you'll take, and you'll always find a trade to take. If you want to mess about in the market, I suggest that you open up another account, put a small amount of money in it, $100, $200, whatever you want, and use that as your messing about account. Okay, keep this one for your serious one, and if you feel like you need some activity because you've had a week or 2 weeks of no trades, go into your messing accounts, play about, win or lose some money, but leave this system alone, so you can do a little bit of back testing, check your results, give yourself 3-4 months trading the system, and find out whether your average win is making its mark, the system win rate, and do a little bit of analysis and just see how profitable it can be, and just find out if it actually fits your profile, whether it's good for you, or do you need something that's a little bit more action packed. But I've been in the markets for 6 years now, and I've had a lot of action. I used to be at the charts on the hour, every hour, even in work, trading off 5-minute charts, just watching it. Whenever I found a minute on the charts, man, I was getting paid for a job to be trading all day just about. I spent more time on watching it on my phone than I did the actual work. But as time goes on and the excitement doesn't die away, but I definitely find the higher time frame and the less you trade, the better your account actually turns out. So I'm looking at daily charts and weekly charts now, going for the long term. It doesn't occupy too much of my time. Yeah, I just spend an hour a day on it, and I get to focus on other things during the day. So it's a trading system is all down to a certain individual and what they're like. But give it a go, see how you get on. It's a very simple system, and I hope you get on well with it. Good luck with it, and I hope it brings you lots of profits. Okay, and let us know how you get on. Anyway, we'll see you in another video. Okay, cheers.